Hello students and welcome to this video on year-end adjustments. This is a question that I want us to do together. This question is called the Boom Boom and it has several interesting adjustments that you have to do and understand. Right, so they give you a trial balance in this question ended on 31st December 2014, and there you will find that you have capital, you have equipment, you have a fixed deposit, you have sales, purchases, you have rental income, you have interest income, you have repairs, and you also have insurance expenses. You have a loan from Abrobank at 18% and you have interest on that loan. The additional information says that the interest on the fixed deposit is still outstanding. So what is very important about year-end adjustments is that we are working with accounts like income receivable, income received in advance, prepaid expenses, and then also expenses payable. So you need to go and figure out, is the account too much or is it too little? If it's too much, you need to decrease it. If it's too little, you need to increase it. So if I look at the first entry, it says interest on the fixed deposit is still outstanding. So if it's still outstanding, the interest income is too little and the interest income needs to be increased, and that will be by a credit entry. Duality tells me that I short a debit entry, and the debit entry will then be in an account called income receivable, because this income should still be received. The second one says rental income was received for 14 months. So what's wrong with that? In accounting, we can account for 12 months or less than 12 months if it falls within our financial period, but we cannot account for more than 12 months. So there's 2 months too much. So it's too much, so I know the rental income, just want to change the color there, the rental income will have to be decreased by a debit entry, and then I will short a credit entry, and that credit entry will be called income received in advance, because it's in advance because the next 2 months relates to the next financial period. Number 3 says that an amount of 1,500 is still owed for repairs. So repairs is still outstanding. Repairs is too little. So I'm just going to say the repairs account is then increased. It's an expense, so that gives me a debit. I will short a credit entry, and that credit entry will be expenses payable. So expenses payable means that I still have to pay that expense. Then the next one, number 4, is quite interesting. And whenever they give you an annual payment and they give you a year, you should know that you need to compare it with the financial year in the question. Number 4 says an annual year payment of 12,000 Rand was made on 1 March with regards to insurance. So the payment would be due then for 1 March 2014 to 28 February 2015. The problem then is that our year end, according to the trial balance, is 31st December 2014. So January and February is too much. It should not be in that period, because the insurance within our financial period is only March, April, May, June, July, August, September, October, November, and December. So January and February should be taken away. So how will I do that? My insurance will have to decrease. So my insurance amount will be decreased, and that would be a credit because it's an expense. So I will short a debit, and that debit entry will be my prepaid expense, because this expense is now paid for the next financial year. A prepaid expense, please note, it's an asset account. It's not an expense account, it's an asset account. Then interest on the loan is still outstanding. That means my interest expense account is too little. So I will increase the interest expense account. I will increase it. That will be via debit entry. I will short a credit entry. And and the credit entry will then be my expenses payable, because this is an amount that I still owe to someone because they've made a loan to me. Here in number 6, they've given you some information regarding your inventory, and they give you opening and closing inventory. The contra account for inventory is always cost of sales. Very important to remember. And here you need to go and figure out what's the effect on cost of sales. So if you have opening inventory, your cost of sales will increase, which means that will be a debit entry because cost of sales is an expense. Why will opening inventory cause cost of sales to be more? Because if you had inventory at the beginning of the year and you're now at the end of the year, that inventory would have been sold. So your cost of sales will be more. If you have closing inventory, the effect on cost of sales is that it will decrease with a credit entry for cost of sales because it's not yet sold. If you have some inventory left, closing inventory in your warehouse, that is inventory that is still unsold, and that will cause the cost of sales to be lesser. Then goods sold on credit, that's a very easy one there. We will just debit the debtor and we will credit the sales because this is a normal entry that we've done before you make a sale on credit. Very easy. In number 8, we pay municipal expenses by check. Also easy, I debit the municipal expense because the expense is more, and of course I credit bank because the asset is less. As simple as that. Previous entries that we have done, and we are actually working per check. Check, very important, means that we are working with a bank account. Then depreciation must also still be recorded. A computer was purchased on 1 May 2014 for 100,000 Rand. Depreciation is written off on the straight line method. Very important. It means that I am going to have to use the cost price to calculate it, and it's 15% per annum. And then the required part says you have to do the general journal entries. Right? So I just quickly want to open a spreadsheet and then we can complete our answer. So general journal, I'm going to have space for the accounts. I'm going to have a debit and I'm going to have a credit. So for the first entry, what am I going to say? Well, my interest is still outstanding, so I'm going to credit the interest income, and I am then going to debit the interest, or the income rather, the income that is still receivable because it has not yet been received. Right, the question then is, what's the amount? Well, if I look at the question, they've given me some information relating to the fixed deposit. They say it's 10% per annum. So if I look at that, I will say, all right, 120,000 times 10% per annum gives me 12,000. But what is the amount that was already received? If I go to interest income, there's already a 7,000 Rand recorded. So I'm going to deduct the 7,000 Rand. And if I say 12 minus the 7, I'm going to get to, of course, 5,000 Rand. So the debit and the credit will be 5,000 Rand that was yet not received at the end of the year. I'm going to write a narration and I'm just going to say interest income is still receivable. As simple as that. Number 2 told me that the rental income was received for 14 months. So I'm going to say debit the rental income because it's too much. Then I'm going to credit income received in advance. Please remember, interest receivable is an asset. Income received in advance is a liability. Why? Because rental income that I've received in advance, there's a possibility that I'm going to have to repay it to someone, pay it back if they're not going to rent from me anymore. right? For interest receivable, it's an asset because it's a bit like a debtor. Someone still owes you interest, so that must be an asset. Right, for the interest received in advance, I will go to my trial balance and I see that the rental income is 72,800. I'm going to divide by 14 because it was received for 14 months. And then I'm going to times by 2 months because it's 2 months in advance. So if I do that calculation, if I divide by 14 and I times by 2, I get a total of 10,400 Rand rental income. That is too much. So I'm going to say 10,400. Decrease my rental income, 10,400 liability. I need a narration, so I'm just going to say rental income is received in advance. Right, number 3. Number 3 says an amount of 1,500 is still owed for repairs, so I'm going to debit the repairs account to make it more. This is an expense, and I'm going to credit, of course, my expense payable. And this is a liability account. Why? Because it's an amount that I still owe to someone. And they say it's 1,500 Rand, so I'm just going to put the debit and the credit. I'm going to have a narration. I'm just going to say repairs is still payable. In number 4, they say annual or a yearly payment of 12,000 Rand was made for insurance on 1 March. So what do I know? Insurance, again, as I've indicated, the insurance amount for January and February should not fall within our financial year. So it's too much. So the insurance account, I'm going to credit the insurance expense, and I'm going to debit my prepaid expenses because I've paid the insurance for January and February. So now I'm going to say it's 12,000. It was paid on 1 March for a year, so it was 12 months that were paid for, but 2 of them does not fall within my financial year. And that should give you an answer of 2,000. So there I'm going to say 2,000 and 2,000. And I'm going to have a narration which says insurance was prepaid. Right, we are now at number 5. For number 5, I'm going to say interest on the loan is still outstanding. So I'm going to debit the interest expense. And for the interest expense, I'm going to have to increase it. And I'm then going to, of course, credit the expense that is still payable. Okay. Then I'm going to say there, it is still outstanding. So how much is the amount that is outstanding? So if I go back to my question, in the trial balance, they say that the loan was taken out at 600,000 Rand at 18%. So if I do that calculation and I say 600,000 times 18%, you should get to an amount of 108,000. Of the 108,000, I should go back to the trial balance again and just check what was the interest on the loan, and the amount for that is already recorded is 54. So I need to deduct it because that's already in my books. So here I'm going to deduct the 54, and in doing so, I get to an amount of 54,000 that is outstanding, and I'm going to make a debit and a credit for that amount. And I'm going to say that interest expense is still payable. Right, number 6 was the entries for cost of sales and inventory. We said the opening inventory causes cost of sales to increase. So we're going to make a debit entry for cost of sales. We're going to make a credit entry for inventory. And that amount is 25,000. And I am just going to say record opening inventory. Then they also give you closing inventory. That causes the cost of sales expense to be lesser. So now I'm going to credit the cost of sales, and I'm going to debit the inventory because those two are always applied together for duality. And the amount given is 32,000 there. And I'm just going to say record closing inventory. Alright, that was number 6. For number 7, I'm going to say sold goods on credit. That was an easy one. I will debit the debtors. I will credit the sales. And the amount there is 12,000. And my narration will be record credit sales. Number 8 was the municipal expenses. So you debit the municipal expenses or costs. You will credit the bank because it's paid by check. And the amount there, 1,600, 1,600. And then I'm going to say I record my municipal expenses as a narration. Right, we are then at the last little entry, number 9, which is your depreciation. So the depreciation was for the equipment, so my double entry will always be debit depreciation, and I will have to credit accumulated depreciation on equipment. Right, so I need to do a calculation. The question tells me, if I scroll down, that it is on straight line method, and 100,000 Rand was spent on a new computer that was bought on 1 May. So now I need to take into account that I have an old and a new computer. So if I go to my equipment, it's 520. So I'm going to say, for the old equipment, it will have to be a cost of 520 minus 100,000, because the 100,000 is the new one, so that gives you 420,000 for the old equipment. I have to calculate it on cost, but there is no residual value given, so I'm just going to deduct nothing there. And then I'm going to say, but what is the method? They tell me it's 15% per annum. So the rate I need to times by 15%. Remember, I divide by years, but I times by a percentage. And then I need to go and figure out the months. Those are the old equipment. So I would have had it in the year before. That means it is 12 out of 12. Just fix that. 12 out of 12. And that gives me depreciation on the old. Depreciation on the old will be the 420 times 15% times 1, because 12 out of 12 is 1, which gives you 63,000. I'm just going to highlight that. That is for the old. How about the new? I have a new one as well. So the cost of the new one is 100,000, and there is no residual. So I'm just going to say minus nothing, because the residual value should be deducted. Then what is the rate? The rate is still, I need to multiply by 15%. And then I need to go and figure out the months. So I'm going to say, when was this asset, the new asset, purchased? They tell me it was purchased on 1 May. 1 May 2014. The year end is 31st December 2014. So how many months between those two? Is it less or more than 12? If it's less than 12, we only record the smaller in value, but if it's more than 12, we only record the maximum of 12. So it was May, June, July, August, September, October, November, December. It was 8 months for which it was used. So I'm going to say times 8 out of 12. And that is going to give me a depreciation on the new of 100,000 times 15% times 8 out of 12, and that gives me 10,000. Just going to also highlight that, and then my total depreciation should then be the 63 and the 10 added together, which is 73,000. So I'm going to record then 73,000, 73,000, and for the narration I'm going to say record depreciation on equipment. Alright, that was then the general journal entries for this question. What to debit, what to credit. I just wanted to again present the depreciation as well. Make sure that you count the months, etc. But it's then that for this video, and I will see you in class. Thank you very much.